Good morning, everybody. It is Tuesday, February 24th. Here is what is on our agenda. The AI scare trade eases through the Asia session. US 10% tariffs are on. And we hear from Kaya Kallas, 4 years into Russia's full-scale war in Ukraine.
Well, as that AI scare trade eases, we are seeing futures pointing higher on both sides of the Atlantic this morning. We saw the S&P closing down 1% yesterday. And as traders pull away from haven assets, gold is on the back foot after a 4-day rally, but it does seem to have found a floor at $5,000 an ounce. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Tuesday. It is Tuesday, Lizzie, and another AI scare grips the markets. Certainly that was the story of yesterday. A little different into the Asia session, but let's linger on the negativity around this Citrini report and indeed the update from Anthropic. So it was the Citrini report that this time took aim at food delivery stocks, credit card companies, some of the private market players as well with exposure to private to credit and software businesses. So that was one part of the story. Then you added onto that Anthropic out with an update on Claude that talked about modernising the COBOL programming language, a dated programming language that IBM uses, and that sent the IBM share price down by 13%. And so it prompts lots of questions about where you can hide, if anywhere. Into the Asia session, things do look a little bit different. There have been some people talking about moving into emerging markets, Morgan Stanley talking more and more about that. The Asia trade on this has always been different. It's always been more about the hardware than the software, and so we see some of those markets opening up after the Lunar New Year holiday, benefiting from that kind of narrative. That's not the case everywhere, though, with Hong Kong having been open, actually in retreat this morning.
Yeah, fascinating to hear from the author of that Citrini report on Bloomberg TV. So essentially, it was a thought exercise in their words about what 2028 is going to look like, and saying that when AI gets cleverer and cleverer, it's going to replace more jobs. It's going to therefore not consumer spending. That will hurt the economy. And so governments need to tax the AI gains in order to help people when they're jobless, right? That, as you say, hit the delivery companies, the payment companies. But the next sectors that are going to be hit is the question. And he's saying that it could be insurers and banks and indeed the ECB looking at European banks' AI exposure. Interesting to hear from Jamie Dimon on this as well.
Yeah, absolutely. Really interesting from Jamie Dimon, because he's on the search for cockroaches connected with the credit markets. He's been talking about that for some time. He's drawing parallels now with the GFC, saying people are doing dumb things for money, basically, lending for net interest income, for NII, in his words. And are there links with AI here? Well, on the one hand, he is saying that maybe there are going to be cracks coming through from the AI trade, and that's what everyone's talking about. But he sees no major impact on credit losses as a result of AI. So that is certainly something that we're going to keep in focus this morning.
And, of course, the private credit, the link here is partly that private capital got caught up in that sell-off because of the loans to software companies. And interesting, on the equity side, Paul Davis, one of our columnists, had the note that software is the biggest single industry among private equity-backed businesses. So a lot of ramifications of all of this.
So there's clearly that link. The other preoccupation for markets over the past 24 hours has certainly been around tariffs. And just 2 hours ago then, Lizzie, we saw those 10% tariffs come in, those global tariffs from the Trump administration.
Yeah, and now we look ahead to President Trump's State of the Union address. Of course, we're going to hear about tariffs. He had threatened to raise that 10% to 15%, but we should note that he didn't officially give a directive to do that. So we're still waiting. We report that the White House is working on that formal order, but the timeline hasn't been finalised yet. And then the US looking at a range of new trade probes to impose new tariffs, but none of them are going to be as flexible as the IEEPA tariff powers originally.
Yeah, absolutely. So the Wall Street Journal reporting lots of sectors that could be in focus. So we'll keep this in mind as we go towards the European Open. So batteries, power grids, telecoms, chemicals and the like. And lots of other parts of the world, the rest of the world, you know, caught in whiplash on this trade policy change from the imposed by the Supreme Court and responding accordingly. Now, President Trump wants things to stay as normal as they've been, or at least wants other countries to stick to the deals that have been on the table. But the EU's paused its ratification process. India has postponed talks on the prior deal. Japan says they're still talking to the United States, but they've warned that they don't want any worsening of the deal on the table. And that's what's difficult for trade partners here, is the US is changing its side of these deals. And so doesn't that leave them justification or at least room to pause, to think and to wait for clarity.
Yeah, the UK likewise saying nothing's off the table if the US reneges on its deal. But then look at the market reaction as well. So we've got gold now pulling back. That's partly because of the AI story, but also because the tariffs news has been digested a bit. Interesting to come back to China back after the Lunar New Year holiday, and base metals like copper have been rallying on the prospect of potentially lower tariffs for China. So look at that when it comes into the ramifications for the European Open. Could be good for oil prices as well. If you've got Chinese exports growing, that could feed into oil too.
Yeah, we'll certainly keep an eye on all of those commodities. With that in mind, let's think about our third topic on the agenda this morning, which is 4 years since the full-scale invasion by Russia in Ukraine. Of course, war predates that, but the full-scale invasion 4 years ago. Talks have been stalling in the most recent history, of course, and fighting seems to be at something of a stalemate. The current conversations seem to be around territory, obviously, about Russia's demands in the east of Ukraine, on control of Zaporizhia and the nuclear power plant there, but so many other questions about how, if any kind of ceasefire can be reached, how it would be enforced. Europe, in the meantime, really trying to find the money, still trying to find the money and trying to find the sanctions and implement those sanctions against Russia.
And yet Europe kind of on the sidelines here. As you say, the EU failing to approve that fresh round of sanctions against Russia because of the opposition from Hungary and Slovakia. It also meant that that €90 billion loan to Ukraine was upended. And then we have EU foreign ministers meeting in Brussels to discuss it all. We've got our chief Europe correspondent, Oliver Crook, sitting down with Kaya Kallas, sitting down with Kaya Kallas later on in this programme. But when does this war end? The big question. And it seems like the hopes that it would be wrapped up by the 4th of July 250th anniversary celebration that Trump is going to be hosting is extremely optimistic. And on the one hand, you could have Russia giving in on some of its red lines. That seems a distant prospect. Or on the other hand, the US abandoning Ukraine.
Right, so yeah, there's still a lot of questions to answer. And according to our reporting, some of the most recent fears that Ukraine has is that even if you get the Russians to a place where they agree on a ceasefire, which is not it's not today's reality, but even if you get there, then how long will that really last? And will that be a ceasefire that actually features sabotage, hybrid war, election interference, and all of the rest that they have come to suspect? So we will certainly keep that in focus and build our focus on that story as we get towards that interview with Kaya Kallas, who speaks on foreign policy for the Europeans. Of course, that coming up a little bit later on in the programme. What else do we have coming up on the programme? We'll, of course, keep AI very much front and centre. Daniele Antonucci will be with us, CIO at Quintet Private Bank. So we'll dive into the AI conversations there, the latest in the AI tantrum. Eric White-Ennis will be with us, JPMorgan Private Bank, EMEA Head of Investment Strategy. He's not seeing any Sell America sign across markets. So what does that mean in the current rotation environment out of software? Brent Hoberman will be with us. Also great to get his view on what's been going on with AI and selling of software stocks. Co-chair of Enterprise Britain and Executive Chairman of Founders Factory. He's got a lot to say on how we kickstart tech within the UK context this morning. And Sandra Horsfield, Investec economist, will be with us to think about the US and global economy then, Lizzie, as we head into 2026 proper and as we wait for the State of the Union address, what the focus will be from President Trump.
Well, speaking of what's on the agenda for today, let's have a look. It is, as you have said, 4 years since the start of the war in Ukraine. And so Ursula von der Leyen is going to be in Kyiv as that war enters its 5th year. She's, of course, the European Commission President. And we have EU foreign ministers, meanwhile, meeting in Brussels, discussing in part how to end the war, but also, of course, how to handle President Trump's latest tariff threats. Meanwhile, we've got Apple's AGM and we've got an ear out for Fed speak from Chicago's Austin Goolsbee. He's on Bloomberg TV at 2:30 p.m. London time. And we'll be hearing from Governors Christopher Waller and Lisa Cook. But the main focus today, as we say, is President Trump's State of the Union address.
Yeah, absolutely. A Tuesday event if you're in the United States, creeping into our Wednesday morning here in Europe. But this will, tomorrow morning, be front and centre for us. Of course, this is a prime-time address. It's a chance for him to speak to the country. And the expectation is that economic policy and tariff policy will get some substantial mention during this. What that involves, we don't know. But he has, as you said, our White House reporting has suggested they are trying to move to that 15% global tariff. So we'll see whether there's any further update on that. But cost of living, affordability, clearly a policy priority as we head towards the midterm.
Which makes selling that new tariff policy even harder. President Trump's poll ratings, the lowest of this second term. we have a great column out actually this morning saying it's more about what President Trump doesn't say than what he does say in this address. Think about the use of tear gas against protesters, the impact of AI on the economy. How much does he actually want to say about those?
OK, absolutely. So matters economic and otherwise in focus for the State of the Union address. And let us get to some other news reports that we need to keep under review this morning. PA Media reports that Peter Mandelson has been released on bail after UK police arrested the former British ambassador to the United States on suspicion of misconduct in public office. This comes after the US Department of Justice released emails allegedly showing him forwarding government information to Jeffrey Epstein. Police also searched 2 properties linked to Mandelson as part of their criminal probe. His arrest deepens the crisis engulfing Prime Minister Keir Starmer over his decision to appoint Mandelson as US envoy despite his known links to Epstein. Mandelson has not been charged and his lawyer has declined to comment. President Donald Trump is pushing back on reports that the Pentagon is concerned that an extended military campaign against Iran could prove difficult, adding that his preference is still to strike a diplomatic deal. US and Iranian diplomats plan to meet for a new round of talks. That's on Thursday. And China has blacklisted 20 Japanese companies and tightened scrutiny on a raft of other firms, signaling Beijing's pressure campaign on Tokyo is not slowing. The curbs mark the latest escalation in a dispute over comments on Taiwan by the Prime Minister of Japan, Sanae Takaichi, last year, when she suggested Tokyo could deploy its military if China uses force to try and seize Taiwan. Takaichi has refused to withdraw her comments on the island democracy, which China claims as its own territory.
Well, coming up, Standard Chartered unveils a fresh $1.5 billion share buyback after reporting weaker than expected fourth quarter earnings. CEO Bill Winters tells Bloomberg the bank isn't missing a beat after the exit of its CFO. Plus, Jamie Dimon says he's starting to see parallels to the era before the 2008 financial crisis, when a rush to make loans ended disastrously. We'll bring you more from those comments. But up next, we check in on markets following yet another AI scare trader out on Wall Street. If you've got any questions of your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months.
That was the Lotus CIO, Alap Shah, importantly, the co-author of the Citrini report, the field of scare trade sell-off. That, of course, was dominating Wall Street in yesterday's session, and there he was speaking to Bloomberg overnight. Now, the bearish report outlined potential risks to various segments of the global economy due to AI disruption, dragging down shares in delivery, payments and software companies. IBM also dropping with its worst plunge in 25 years. That was driven by some news out of Anthropic, but still fitting in with that overall theme of concerns about what AI will and won't do to tech businesses. Let us speak to Daniele Antonici, co-head of investment and CIO at Quintet Private Bank, who's with us this morning. Daniele, nice to have you with us. Thank you for joining us. So that was the author of the report that's been much talked about, much cited over the past 24 hours, talking about what he sees as the losers from AI, or at least what could be, because it was just one scenario that got a lot of attention. Do you think we have a good sense of where the losses from AI will fall at this stage?
I think we are looking at this too much at an aggregate level. We need to be much, much more granular when you look at these things. So for me, there's going to be losers, but winners as well. We talked a lot about the enablers within the tech sector, then the risk, the valuations might be demanding. Now we're talking about some of the sectors and the companies that might be impacted they're going to be also beneficiaries from AI. And so we need to do more work and go deeper and to separate those who could benefit from those who will lose from
Okay, I mean, yes, so will any of those beneficiaries, will they be in the sectors that have been beaten up? Software or white-collar jobs in general? Because I suppose the end answer can't be that all software loses and all hardware gains. Otherwise, why is hardware gaining? So I mean, where will some of those gainers be?
Yeah, that's correct. So first of all, I would talk about size. For instance, I think that for the smaller, less profitable, unprofitable, more indebted firms, there's a problem there. Valuations are frothy. We might be in a bubble after all. But for the more dominant ones, I think the picture is different. For firms that have an economic moat, quasi-monopoly, duopoly, oligopoly, they could be the winners. And when it comes to jobs, I think the picture is more nuanced. It depends on lots of different things. One is the pace of this structural change. Then, secondly, the practical utility of this technology, and there's a lot to figure out when it comes to that. So I think it's not all bleak. The reality, like we have seen from your interview with Lotus CEO, there I think the problem is that these headlines are created a lot of uncertainty. The trade has gone on for quite some time. It's been a multi-year trade. Valuations are elevated. So to me, the top-down dimension is much more important. And to our clients, we talk about diversification. We talk about hedging the dollar exposure. We talk about combining long-term AI exposure with other sectors as well.
So for you, this idea that 5% of white-collar jobs could be gone in 18 months because of AI is just hyperbole, right? But when you talk about the winners and losers, I get that there'll be winners, but how many losers do you need to have to pile up before it's a broader drag on the market?
I think it's hard to answer that. My point is that pinpointing a number, is it 5%? Is it a very small percentage? Is it higher than that? We'll see, but I think we need to differentiate. So when we look at investing, in my view, if the question is where long-term growth will come from, I think it will come from U.S. equities, the U.S. market, the U.S. economy. But obviously, valuations are a bit on the demanding side at the moment, and so we like to diversify geographically, sector-wise, and across a lot of other dimensions as well.
OK, so it's not a sell America narrative for you, even though we had all of that tariff drama over the weekend. I also want to talk about the impact of that, because you're underweight treasuries. Are you even less confident in the U.S. fiscal position because there's going to be less tariff revenue?
Yeah, I think a little bit. I think that fits into the story. So if you look at our equity strategy, it's quite global, effectively. But because the U.S. represents 2/3 of the total, we typically take some of that and reallocate, diversify to other geographies. Emerging markets, for example, is one of our highest conviction call. You have more attractive valuations. It's one way to diversify the AI story too. Remember, DeepSeek could benefit from dollar weakness, so we like emerging markets, for example, alongside the US. Then when you look at fixed income, it's the opposite. We are quite local. We're mostly European investors or UK investors, so we are underweight. We maintain a reduced exposure to US treasuries. If you think about it, that the GDP in Germany is in the 60s, so much, much lower. There's capacity to spend. The fiscal picture is stronger, is more under control. So we have an overweight position in European government bonds or UK gilts and variants of that, but a much reduced exposure on treasuries.
And you, Daniela, you say you are mostly European or largely European investors, and yet you're worried about inflation. I wonder where your inflation concern is coming from right now.
Well, inflation, I think, comes, or the inflation concern comes from the fact that we don't see interest rates coming down that aggressively. That is global. Obviously, the European Central Bank has been leading this. In the Eurozone, inflation is more under control. It's below 2%. The key policy rate is 2% as well. But in the US, especially, I think when you try to look at the AI themes, there's two time horizons that are very relevant. One is the near term, but could still span quite some time. And what these technologies have in common is that they are energivore technologies. They consume a lot of energy.
Yeah.
There's a lot of competition for resources as well. They tend to suck up a lot of these resources. And so I think that actually that could be inflationary.
Yes.
There could be capacity in the short term. There could be capacity constraint.
So AI, how the AI ties into your view then on inflation?
That's right.
It boosts inflation in the short term, but in the longer term, is it deflationary or disinflationary? I mean, we've seen technology over time often has been.
Yeah, exactly. So it could be disinflationary at longer horizons. Try to buy a plasma screen, and you need to adjust for quality. But there could be more a disinflationary bout. But if it comes, I think it will come later on at longer horizons.
What if we see more euro strength? We saw it yesterday off the back of the tariff drama. How does that affect the ECB's rate path going forward? Would you be expecting to see more cuts, for example?
Well, if you ask me, first of all, I thought actually, in general, if you look at the overall market, the reaction to the tariffs itself was fairly limited. There were more redistribution effects. For instance, you could say that because of this, it's a flat tariffs, you have the emerging market complex that benefits where the average tariff level is actually lower than it used to be. We'll see if that's maintained. While if you look at the Western world, Europe, the UK could be another example, Japan as well. If you look at developed markets, that level is a little bit higher. So there's a redistribution effect, and that plays into our view that emerging market benefits are an overweight. They might benefit. But generally speaking, the euro, we think there is more to go when it comes to dollar weakness and euro appreciation. Obviously, we've already seen quite a bit last year, so I think it's going to be moderate from here. We're not at the level that would suggest that the ECB needs to lower interest rates, but I would disagree with the view that the next move will necessarily be a hike. I don't think it's a given.
Do you think that it's undermined Christine Lagarde's credibility at all, where she's been accused of not rebuffing the speculation that she's going to quit early for political reasons? She has said just yesterday that her baseline is she'll serve out the rest of her term, but some have said that she hasn't done so quite as vehemently as when this speculation has risen before.
We'll see, but I think the ECB has done a really good job at taming inflation, at lowering the rate path. Actually, I think the ECB and its president has a lot of credibility.
Mm. I mean, you make a point in your notes, Daniele, of saying that you don't trade geopolitics, and it's easy to see why you might come to that conclusion. I mean, things around Iran remain very unpredictable. You instead load up on some inflation protection, maybe on commodities, I think is part of the argument there. But where does trade fit into that don't trade geopolitics mantra? That's something kind of separate, surely. Do you have to trade around the trade theme?
Look, I think it's more nuanced, and I think you see that when you have risk-taking responsibilities. Obviously, we all understand rationally that crystallizing a loss in a real portfolio because markets are down to get back in at a higher level later on is obviously not a winning strategy. So when I say don't trade geopolitics, I mean don't trade the headlines. Yes, we have a geopolitical view, and that view is expressed in geographical diversification. We used to live in a much more unipolar world. Now it's multipolar. The US is more inward-looking. So diversification helps because when you have a wobble in one part of the portfolio, European equities, because of the situation in the Middle East, maybe your commodities or gold position benefits, and vice versa. That's what I mean. But trade policy, geopolitics, they do matter for markets, and so we need to have a view.
So, position around the volatility, but maybe don't lean into it. Daniele, great to have you on. Daniele Antonucci, co-head of investment and CIO at Quintet Private Bank. Well, coming up, as the war in Ukraine enters its fifth year, the EU's Foreign Affairs Chief, Kaja Kallas, joins us to discuss the European security strategy. We'll be bringing you that interview with our Chief Europe correspondent, Oliver Crook, next, as we look at futures as we inch towards the cash session in Europe, ever so slightly higher. Euro Stoxx 50 futures up 1/10%, but FTSE 100 futures flat to the upside. Meanwhile, a lot more positivity as we look stateside. S&P E-mini futures up 0.3%. So that AI scare trade appears to be falling back. Stay with us. This is Bloomberg. 30 minutes from the start of the opening trade, you're looking at futures inching higher on both sides of the Atlantic this morning, more so stateside. It looks like that AI scare trade is easing yesterday, and already in the Asian session we had seen the MSCI Asia Pacific Index up a bit, but it's now completely flat, Anna, as we look to the Asia session.
Yeah, absolutely. So the Asia session giving us a very different take on AI winners and losers as it reopens in large part from the Lunar New Year holiday. Some of it, of course, was fully operational already. Let's have a look at what we've got on the European bond market story then. We're waiting for some of these bond markets to get fully into their stride, but just opening up. And again, there, things looking broadly pretty flat, really. The big story in bond markets overnight, perhaps coming through from Japan. Well, there's a couple of things. We're watching what's going on in the States, watching the fiscal impact of the tariff policy. Will we get any more on that as we get towards the State of the Union or during that address? Perhaps not the time for it, but that is the focus for Treasury markets, it would seem. And when it comes to the Asian session, the focus for bond market traders has been around Prime Minister Takaichi apparently voicing some apprehension to the BOJ on more rate hikes. So how that filters through into JGBs is interesting to watch. And we do seem to see some movement downwards in some of those yields in JGB markets overnight. So we'll keep an eye on that.
Well, let's get back to the geopolitics. EU leaders, including European Commission President Ursula von der Leyen, are in Kyiv for a day of remembrance as Russia's war on Ukraine enters its 5th year. Despite President Donald Trump's pledge to end the conflict within 24 hours of taking office last January, there is no end in sight. Multiple rounds of talks have taken place since then, including the Ukrainian president's very public Oval Office clash with the US president and Trump's summit with Russia's President Vladimir Putin in Alaska, when they spoke for more than 2.5 hours. The sticking point remains territory. 3 rounds of talks so far this year alone have failed to deliver a resolution, and Putin has given no sign that he's willing to roll back on demands that include territory his forces have failed to conquer in Ukraine's Donetsk region. Well, let's bring in Bloomberg's chief European correspondent, Oliver Crook. He's in Brussels with a special guest.
Yeah, Lizzie, there you sort of cataloging the last 4 years that we have been living here in Europe and, of course, in Ukraine, fighting that war of Russian aggression and trying to repel that invasion, which now marks the first day of the 5th year of that war. And we're joined now by Kaja Kallas, the European Union's High Representative, to get your sort of assessment of where we are now for 4 years. 1 day into this war. How do we prevent, and what is the European role in preventing us from having this conversation 12 months from now?
Well, I think it's important that we stick to the basic principles that there's one aggressor and one victim. Why is it important? It's important because at the negotiation table there should be clear demands on the Russian side. Right now we see a lot of pressure on Ukraine, who's the weaker part, to concede territories, to give in what the aggressor wants, but actually we don't see much pressure on the Russian side. Of course, the European position has always been very clear to put the pressure on Russia, and we are working on that, but also around the negotiation table there should be very clear demands to Russia.
So the European position has been clear. European action has become less clear, particularly over the last 24 or 72 hours, in which we had a failure to deliver the 20th sanction package yesterday. Over the weekend, we've heard from Viktor Orban basically now stepping out of line with the agreement for the 90 billion euro loan to Ukraine. Where do you see the path forward for both of these initiatives now, given where we stand?
Well, this is a very unfortunate development because all the leaders agreed around the European Council table in December to provide the loan, and also we have been working on the 20 sanctions package. Now there is a veto on both of them. Of course, we are working with Hungary and Slovakia on different levels to find a solution, but this is very, very unfortunate. Of course, on the positive side, we have seen this before, and we have always come to outcome and solution in the end.
And there's also a sort of deadline looming. We understand that the loan package was going to begin to be dispersed in April of this year, and that was sort of seen as the critical moment to get some of this funding to Ukraine. If there's not a resolution by then, what are the options? Does this put, for example, the Russian assets back on the table?
I think so, yes, because this loan was a plan B, actually, because there were some countries that were opposing to the frozen assets, but it's clear that Ukraine needs this funding in April, and like many analysts have said, this could be a game changer for this war, to send a clear message to Russia that you can't outlast us, and we are supporting them to defend themselves.
And do you think there is going to be the legal framework to try to move on those Russian assets? Obviously, that was the point of failure last time, particularly with the Belgians still objecting to that. Do you think that that has evolved? Has there been legal work happening in the background to try to make that more viable?
No, there hasn't, because there was this 90 billion loan, and we were moving quite well on this track, also on how this, there's flexibility for using this money, considering the Ukrainian priority and urgent needs that they have. So of course there has not been any work regarding the frozen assets in meantime, and we should right now, focus on solving this issue on the 90 billion loan. There is discussion on the leaders level and different options on the table, but if that's not going to work out, then of course the frozen assets is a possibility.
And so sort of Hungary and Slovakia to a certain degree is not a new dynamic within the European Union, particularly on the question of Ukraine. That being said, there's one thing that these two nations share, and they both had a visit from Marco Rubio in days after the Munich Security Conference. I wonder what your perspective is on that, not to sort of enter into potential conspiracy or anything like that, that this is the U.S.'s influence. That being said, it does give these two nations a direct line to the United States and potentially emboldens them to go against European policy because they have the United States as a very clear sort of stated ally. What is your perspective?
Well, America has been very clear that they want this war to end. So if you want this war to end, then we should really do everything to put the pressure on the aggressor. And what the 20 sanctions package would do, in addition, we see that Russia's economy is not doing well at all. Their approach has been to put pressure on the victim, on Ukraine. It hasn't really delivered in 1 year. Results, so maybe we should focus now on the other side. So clearly it would be also in their interest that these things go through.
And sort of appraising the European kind of stick and carrot in terms of being able to put pressure on Russia or help out Ukraine. Obviously, there's the funding question that is now in sort of jeopardy. There's a question of sanctions, also now reaching some issues. There's also the idea of joining the European Union and this being part of the framework for a peace agreement from the Ukrainian side. Given how much difficulty there has been with the two sort of former, where do you see the sort of path in the discussion around accession to the European Union for the Ukrainians, particularly given the resistance we're seeing from these member states?
Well, there have been some ideas circulated how we can approach this question, and then we really need to have these discussions on different levels. But what I want to stress is that anything around the negotiation table that requires European input also requires Europeans around that table, and anything that from the European side we are putting to the table should not also be without the concessions on the Russian side. So to be very clear, Ukraine's place is in Europe. They have been fighting for Europe and joining the European Union. So we definitely need to find a solution, but not only for Ukraine, but also the other countries that are candidates. And
some of the sort of issues that we've been talking about, or some of the things that are being discussed that you mentioned there, are membership light, for example, for the the accession to the European Union. Do we have a clear idea of what that would actually entail, just to put a little bit of meat around that debate? Because we hear these ideas floated out, but they're not really, strictly speaking, defined.
Yes, well, we haven't had those discussions, and yes, last week I was also proposing that we would we would have these discussions on a broader scale, because clearly if member states, candidate countries are making their homework or doing their homework, then it shouldn't be that we haven't done our homework.
And also thinking about the United States relationship, we obviously had the Greenland moment. I don't know if we can consider that a moment. I don't know if it's sort of gone for the time being. We had Marco Rubio sort of giving a sort of, I'd say, semi-reassuring speech over at the Munich Security Conference. Where do you appraise the United States relationship with the European Union today? Do we understand each other better at this stage?
Well, our relationship is definitely taking a heavy blow. That's clear for everybody. We are trying to work on this. Of course, it goes both sides. A relationship is two ways. So we definitely want this relationship to work. And are doing our efforts on our side, but it takes two to tango.
And sort of tariffs obviously are now re-emerging. We had our tariff moment. It is now seems to be a tariff year plus. Just to get sort of, we're trying to assess kind of what the situation is, what the consequences are. At this stage, can you help us out assessing what the situation is and what the consequences are?
We are trying to assess this situation as well, because nobody understands if this 10% is now on top or how is it really playing out. Plus, when we agreed to this trade deal, then one of the arguments was that our companies would have stability. Any kind of decision is better than hanging on and not knowing what is coming. So predictability is a value. Now it is again gone. So we are trying to make sense how the U.S. operates.
And so obviously trade is under Mr. Šefčovič's sort of remit, but obviously trade is also increasingly used as an instrument of foreign policy. Do you see a potential consequence of foreign policy in terms of the sort of disagreement or confusion around tariffs is now forcing the EU to delay their deal? Could that have, for example, consequences for the Ukrainians and U.S. support if, say, the Europeans are not moving fast enough in the minds of the United States?
Well, in a broader sense, of course, trade is very much linked to the foreign policy. And if you go around the world, then actually most of the countries in the world have been hit by tariffs, and nobody understands really why. So I think on our side, it's important that we are building partnerships with countries who still believe in free trade, and we are trying to diversify our trade portfolios so that we are not vulnerable in that sense.
And another debate that's been happening at the European level recently is this made in Europe idea, this idea of sort of funding, particularly going on in the defense build out, that they should be sort of made in Europe. Do we have an idea of where we're drawing the line of Europe? Is it including candidate countries? Should it include Ukraine? And the United States, should it be considered a trusted partner? Can you put a little bit of flesh on that debate for us?
Of course, we are building our own defense industry, and therefore, the defense industry also needs procurement. But at the same time, the world is very much interlinked. There are many elements that come from different countries. And definitely, we work closely with our partners that we have security and defense partnerships with. We work closely with our partners in the region so that, we come up with the best way forward. That means bringing down the procurement costs, but also bringing down the procurement times that are so much needed.
Well, High Representative, thank you very much for your time. Greatly appreciate it. That's Kaja Kallas, the High Representative for the European Union on Foreign Affairs and Security Policy.
Ollie, thank you very much. Bloomberg's Oliver Crook there with Kaja Kallas over in Brussels. And really interesting, roaming across a number of subjects, but going back to where they started, around 4 years of full-scale war by Russia in Ukraine. Kaja Kallas wanting to make that point that there is one aggressor here and suggesting that the US strategy of putting pressure on Ukraine, on the victim, has not worked. Interesting on US relations as well with regards to Greenland, saying, it's no secret, this relationship has taken a heavy blow.
It takes two to tango, she said. But yeah, all of that tied in together with the tariff story, real confusion expressed there about what happens next, what happens with that 10%.
Yeah.
And that's hence why they've frozen the deal so far.
Yeah, absolutely. Frozen the passing of it in the Parliament, haven't they? And we heard Christine Lagarde of the ECB talking about this subject, talking about trade yesterday and talking about the need for certainty and clarity there. She was also talking about other subjects as well. Christine Lagarde reiterating the importance of central bank independence.
Without that independence being protected, being cherished, and being celebrated as well as protected by accountability. I don't think that we would be capable of responding in the way we have.
Christine Lagarde there speaking overnight in Washington. More on the markets when we come back. This is Bloomberg.
Very good morning. If you're just joining us, it's 7:48 here in London, and we are getting closer to the European market open. Take a look at the futures picture here, and we are inching higher on Euro Stoxx 50 futures, flat to the upside, really, but it's a mixed picture across the continent. The CAC looks set to open a touch lower, and the FTSE set to open flat, Anna.
Yeah, absolutely. A picture of unchanged, it seems, for the European equity markets. That's what we're expecting, at least in 12 minutes' time. Let's talk about these markets. We're joined for 3 minutes on the markets by Adam Linton of our Markets Live team. Good morning to you, Adam. So, I mean, Europe yesterday a bit more resilient in the face of the latest AI tantrum than the US. Asia certainly more resilient this morning, not everywhere, but in a lot of places. But I suppose the argument can't be that hardware is going to do great out of AI and everything else is going to lose. I mean, there's got to be other winners too, I suppose. So what do you make of the latest sort of US versus the rest of the world trade here?
I think for the US, I think, ultimately we are kind of seeing this AI displacement effect pronounced most, prominently there. And that's very much outweighing the AI benefits. And I think with the thing at the moment is more like the news flow that we're seeing. Basically, every day we're seeing, software at the eye of the storm. Then we're seeing something peripheral or adjacent to it being taken out. I mean, we saw American Express down over 6% yesterday. And I just think as these, these tape bombs, these new reports, these new angles keep coming into the market, it's just very difficult to navigate if you're a US investor. And I think the best part of it is to kind of look elsewhere. And as you mentioned, yes, some of these kind of shovel and pick APAC stocks, if you look at the South Korean Kospi, they're benefiting. And I think they will continue to benefit because people just have this broader risk aversion to the US at the moment. And at a time when global growth is relatively strong, I think that trade does make sense.
So is yesterday a sign of things to come through 2026, that you fade the tariff noise and focus on the AI scare trade?
Not as kind of, shrugging at the tariff story as, some people are. I think the tariff story is a concern. Yes, we may get to the point where the effective tariff rate may be relatively unchanged from what it is now. But what we're kind of seeing is we don't really know what the composition of those tariff effects are. And, we saw the weekend, 1 minute Trump was 10%, then it's 15%, and now today it's 10%. And this basically just kind of plays into the point that there's just so much policy uncertainty from the US. And concerningly, yesterday we saw the equal weight S&P close lower, we saw the Russell close heavily lower. And I think that's a particular concern for the US stock market because some of those areas have actually been propping up things. So I think if you have the twin effects of AI displacement hitting some of these software stocks, and then you also see, some of the tariff anxiety, creep into the US, yes, we may have the taco trade, but the noise and the uncertainty on the way is just another factor for traders to have to factor in.
Certainly a lot of noise and a lot of uncertainty. Let's go to Japan and what's happening there. We've actually seen the yen and JGB markets responding to some reports from other media in Japan suggesting that the Prime Minister there has voiced apprehension about further rate hikes from the BOJ. How seriously do we take that kind of commentary?
I think you should take it relatively seriously. I mean, I was always, apprehensive myself about the rally that we saw in the yen post the election. It was kind of built on this narrative that Japan was going to be, fiscally responsible. We're going to see too much in the way of bond issues ramping up. But, reports were suggesting the complete opposite. We saw soft Japanese GDP at the end of Q4 suggesting that more stimulus may have been needed. So I didn't really buy into this, kind of pivot that we saw in the narrative post-election. And, the interest rate channel was one of the positives people were citing. But if we do see this begin to waver, that really does, undermine the yen. And you also combine that with some of the geopolitical headlines, Japan and China clashing, then I think, we could potentially see a bit more of a material move higher in dollar yen. And people may now need to think about 160 possibly again in dollar yen.
OK, well, we're at 156 per dollar right now, weaker nearly 1% the yen against the dollar. Adam, thank you. That's Adam Linton from our Markets Live team. And don't forget, you can get up-to-date analysis and insight from the team by going to MLIV Go on your terminal. Now let's get to your stocks to watch with Charlie Wells. Charlie.
Good morning, Lizzie. There is a lot to watch this morning, and we have to start with Standard Chartered because they just dropped their earnings report. Hargreaves Lansdown just sent out a note calling that report messy because profit missed expectations. But when you dig in, you actually saw some good numbers coming out of their wealth management unit, from their global banking unit. You can see this drop last month as well. And this gets to another question that we're seeing about succession, because that drop happened after the surprise departure of their CFO. So questions about succession. We've got a nice quote here from Bill Winters, the CEO of the bank, who is very familiar in these halls, but who has also been in post for 11 years. So the succession risk at Standard Chartered, at a number of other banks across the globe, really in focus for investors. So interesting to see how that pans out. We also want to take a look at the auto sector, because this morning we got a really interesting report showing that after 6 months of growth, there was actually a drop in sales in Europe in autos. So taking a look at how this could affect a number of these auto stocks. We've seen they've had something of a bumpy ride over the past couple months, over the past year. So really focusing on how that starts to digest, and also looking at that broader ecosystem of suppliers, of tire companies, etc. That is where the smart money is focusing. Smart money also asking questions about this delivery ecosystem, Delivery Hero. We've got to turn to them because we had that AI scare trade across the board in the United States, hitting a lot of these consumer discretionary, these services stocks delivering food to consumers, Uber Eats, DoorDash, etc. Let's see how that plays out in Europe. Does that start to temper out, or does that pattern repeat itself like it did in the U.S. here in Europe today?
Charlie, thank you very much. Charlie Wells with an update on some of those stocks that could be in focus. And Lizzie, just a moment, I think, to think about where we've been. US futures are pointing higher, but that is in the context of the losses that we saw yesterday. The European session was a bit more resilient to the tantrum around AI yesterday, but we did have our areas of weakness, certainly within financial services. We saw some of the private equity names under pressure. Within media, we saw some of the advertising names under pressure. And it's there that we have seen some of the fears around AI linger in these markets.
It is. And just going back to Charlie picking up on earnings, you mentioned StanChart. We also heard from Telefonica, indicated lower on TradeGate as we approach this session. Their fourth quarter revenue missing estimates, so keep an eye on that stock as well at the open. We're inching towards the cash trade. It's 7:54 a.m. here in London, and futures flat to the upside. This is Bloomberg.
Welcome back. This is the opening trade. Just a few minutes then until the start of cash equities trading here in Europe. Let's cast our minds back to the session that was Monday in the United States, because it is a little instructive as to where we will or won't go at the start of the European trading day this morning. So this yellow line, of course, marks where the European markets closed. And after that point, the US didn't do very much, which is one way of explaining why our European futures picture looks a little lackluster. Add into that, though, we have some positivity around the hardware names. That's coming through from Asia. That doesn't seem as if it's going to factor too much in our thinking here in Europe. But these numbers are only very slightly into the red. We're pretty flat, really, on the European futures picture. Yesterday, we did see some of the AI frenzy and the AI nervousness sticking to some European sectors, certainly in financial services, around the credit markets, also around advertising in the media space. So we'll certainly keep those under review once again. We also saw quite a lot of negativity around the pharmaceutical space with regards to Novo Nordisk. So we'll certainly watch that one and see if there's another day of moves on that story. But Lizzie, for the moment, the futures picture looking pretty flat.
Well, let's dive into some of the stocks that we're keeping an eye on at the open. And we kick off with earnings, really. Standard Chartered reporting a fresh $1.5 billion buyback. Profit missing, though. And this is, of course, after the surprise departure of the CFO. We heard from CEO Bill Winters earlier saying, I don't know why the former CFO left. So we'll see how the market reacts to these earnings at the open. But we also keep an eye on auto stocks after European car sales fell in January. And back to earnings, Telefonica earnings bolstered by growth in Spain and Brazil, but indicated lower on TradeGate because of reporting revenue for the fourth quarter that missed estimates. Anna, we're getting towards the open.
Yeah, absolutely. Just seconds away then from the start of the cash equities trading session. And it looks as if it could be a little underwhelming, Lizzie, given the futures picture has been telling us that we're not going to go anywhere very far at the start of the trading day. So the FTSE 100 is open and true to form, not really moving very much. We might have to wait a little while for the likes of the DAX to open up this morning. A focus on the banking sector then as a result of those Standard Chartered numbers. We saw the Hong Kong listing. That stock went quite a bit higher, despite some of the areas of disappointment, maybe the share buyback cushioning the blow a little bit there. So we'll watch what happens with Standard Chartered. We are starting to see some opening up of these European markets. The CAC 40's actually down by 0.3%, so a little more negativity perhaps there in Paris than had been anticipated. The IBEX down by 0.2%. Lizzie, what do you see in the sector breakdown?
Well, as we look across the continent, you're looking about just over half of sectors in positive territory. Energy leading the gains this morning, up 0.6%. Autos and parts actually up 0.5%. Utilities not far behind. Chemicals, tech, retail also in the green. But bottom of the basket, banks down 0.8%. Healthcare also down. Telecoms, media, real estate all suffering this morning. So for those individual stocks that we had flagged, StanChart actually up 0.3% now off the back of their earnings. And Telefonica up 1.25%. So actually, Tradegate was wrong. We're looking for instead at this growth that we've seen in the likes of Spain and Brazil on that stock.
Right, and the DAX not open just yet, so we're waiting for any movement there. Interesting that I was just looking to see what technology is doing, and technology is higher by a little bit, and ASML is one of the gainers there, so up by 1.4%, because I was wondering why the AEX was outperforming, and that's usually the reason, and it is the reason this morning. So ASML is up by 1.4%. So maybe there is something in that hardware strength story coming out of Asia that is filtering into the European session, but overall we are a little bit weaker than this morning, down by 0.2% on the Stoxx 600. Let's widen our conversation, bring in another voice, and I'm pleased to say we're joined by Eric White-Ennis, who is Head of EMEA Investment Strategy at JPMorgan Private Bank and joins us around the desk this morning. Very nice to have you with us, Eric. Tuesday, 24th of February. We have another AI tantrum under our belts on Wall Street yesterday. What are we continuing to learn about where the losses from AI will fall, do you think?
Well, you alluded a little bit to one of the factors that seems to be going on, which is the market expressing a preference for hardware relative to software. And if we think back, it was just a short while ago where seemingly everyone in the market was focused on, is AI a bubble or is it not? And now the new focus seems to be, who is most at risk of disruption from AI? And that certainly seems to be something that may be playing out in the weeks and maybe even the months to come.
And are there places to hide? Because some people talk about emerging markets, talk about Asia and the hardware stories, and maybe you hide out there. Others you hide out in commodities and the things that are going to power data centres. And some say you can hide out within stocks. You just have to move to, I think it's being dubbed the halo stocks, heavy assets or low obsolescence risk. I mean,
yes, a new acronym. We love acronyms on Wall Street.
We all need another acronym. So where do you think we hide out from this volatility?
So the phrase broadening out has been used for quite some time on the street, and it is genuinely occurring mathematically so far this year. Interestingly, the headline index is essentially flat as a pancake. However, you have the equal weight that is outperforming, the cap weight that is underperforming, and that's a statistical illustration of exactly that. It isn't just big tech that's driving the market forward. And in fact, we have an increased preference for sectors such as utilities and industrials, companies that will be components into the AI theme and ideally less at risk of being directly disrupted by the AI theme.
But as we head into the NVIDIA earnings, what is the broad feeling on mega cap tech? Is it now that you've had a bit of a sell-off, it's starting to look attractive again? Are we there yet? Can we give a read on that?
I think that's the right way to look at it. Ultimately, this cohort is continuing to grow earnings at well north of 20%. Most quarters on a very consistent basis. And in fact, on a broader market basis, we're now going to finish, as per this earnings season, with the 5th quarter in a row of double-digit earnings. So that's kind of the broad market, which does indeed continue to be led by big tech. So if you feel as though the broadening out theme has a degree of legitimacy, which we do, but you do also want to continue to be invested in the most innovative, free cash flow producing companies that are growing their earnings at such an impressive clip on a consistent basis, then big tech very well may be interesting for those that might want to step back in to some of the softness we've seen recently.
I think what's interesting is how different your perspective is to Daniele Antonucci, who was on earlier on. He's kind of saying there's volatility out there and you need to position around it. Whereas, if I understand it, your view is more lean into the volatility, embrace it. What does that mean in practice?
So absolutely, we love volatility, and it can oftentimes provide opportunities to step in at more attractive valuation levels. You can also make volatility your friend, so to speak, utilize things such as the options market, structured note-oriented strategies where you're a degree of a seller of vol to produce a degree of protection while also achieving a good asymmetry to the risk-reward profile that you can get by stepping into vol. One of the most tried and true approaches in investing over time is the Warren Buffett style approach of being greedy when others are fearful, and when volatility really tends to spike. If you like the underlying attributes of the investment, the cash flow attributes of the company and their business model, then you kind of need to summon that investment discipline to indeed step into vol, and that's what we tend to do over time.
So there's something sort of counter-cyclical about that, or counter-trend about it. I mean, you've talked in your notes, Eric, about how cash allocations are too high in many portfolios right now.
Way too high.
So what explains that, do you think, and where do you think that money should be going instead?
I'm not entirely sure what explains it, to be honest. I think it may be the comfort. It feels a little bit like a warm blanket or something along those lines. But we tend to advocate a very low percentage of one's wealth being allocated to cash, whereas many portfolios that we see, even for extremely wealthy, extremely successful families all around the world, it's oftentimes 25% or more. One of the big things that we're trying to advocate that our clients do right now is rotate cash into carry-producing strategies. So strategies that can produce a greater degree of income, yes, by taking on a degree of credit risk, yes, by taking on a degree of interest rate duration risk. And we really think that that's a sensible approach, because the 25%-ish zone for cash, we just think is much too conservative, and it isn't going to compound your wealth nearly as effectively as carry and other growth-oriented strategies can.
It's interesting. It comes at a time when we've been worrying about fiat currencies. I mean, we were worrying about the dollar, but we were worrying perhaps more broadly about fiat currencies and what central banks were doing to them. Is there any connection there with why people... I mean, it doesn't make sense, really, in that context, to sit on a lot of cash, does it?
So you have the debasement trade theme that's been talked a bit about, and that's certainly a big part of why gold has been performing as strongly as it has been. The physical central bank accumulation story, both by developed market central banks and probably increasingly by emerging market central banks, is a component of that. But we don't see a huge risk of fiat paper currency issues. Sovereign yields, so longer term yields, have actually been easing down a little bit. The U.S. 10-year yield is close to 4%, for example. We know that there was certainly a very large U.S. dollar sell-off in 2025, and that was a factor for many overseas investors. But we don't see that type of pattern repeating in 2026. We're only slight dollar bears for this year.
Is that partly because you expect perhaps fewer Fed cuts than the market's pricing?
We do. We only look for one, maybe two. There are some out there that believe that it could be 3 or 4 and that the Fed might need to move in a more dovish-oriented direction. We think it's going to be fairly muted in terms of what the Fed does, and therefore you're not going to have this huge southbound interest rate impetus to drive the U.S. dollar lower. And the Sell America theme that developed a bit in 2025, we also don't think is going to be repeated in 2026. We think it's more so going to be a case of investing in the U.S., but also investing internationally alongside the U.S., a bit more of a globally diversified approach, and inflows should continue into the U.S.
What are private bank customers saying about private markets? How does that subject loom on their agendas when they look at what's happening in public markets? I don't know, does that give us comfort that you hide in private markets, or does it make us think if it's happening in public, it's happening in private as well?
Part of what's interesting about private markets is the investment discipline that it forces upon the investor into it. If you have a multi-year type of time horizon into some of these investments, it sort of enforces the discipline of taking that long-term oriented lens. And if you can choose the right managers, either in growth or in credit, ideally you can get an alpha premium for that trade-off of that illiquidity and some of the underlying components of what you do in those investments. And that's what makes it worth it. So we have seen families that we work with continue to lean in to private markets. If you can get the outperformance relative to public markets, which we've been able to largely achieve over time, then it's worth it.
And are they loading up on exposure to private markets, or the opposite, or is it kind of consistent?
I would say consistent overall, but one of the areas that we're seeing an increased amount of interest into recently that I have a lot of passion about is private infrastructure. So many wealthy families around the world have stuck with the more relatively traditional aspects of private markets, but private infrastructure offers some really compelling attributes, bond-like consistency of cash flows, very low levels of volatility, and almost no correlation whatsoever to everything else that's happening in terms of the macro environment. So if you want something that's a bit differentiated in your portfolio, that has a smooth ride and isn't as linked to everything that we talk about each and every day in markets, private infrastructure can really fit that bill in a diversified portfolio.
Okay. Eric, great to have you back. Eric Tennis, Head of EMEA Investment Strategy at JPMorgan Private Bank. Thank you so much. Let's have a look at the core six, shall we? This is what we're seeing this morning. Of course, we have Novo Nordisk, LVMH, Rheinmetall, all on here. And it looks like luxury's on the back foot this morning. LVMH down 0.8%. Novo suffering, down 3.5%. But gains for Rheinmetall, ASML, Schneider on the back foot. Nestle, though, up 1.3%.
Yeah, I was looking at the banking sector. Really interesting that we've got the banking sector quite as weak as it is this morning then, Lizzie. And we're down by 1.9%. On banks overall. That's not a Standard Chartered story because that stock is actually quite resilient. It's not up, but it's pretty flat. Erste Group, ABN, these banks, Bank of Ireland, these are some of the worst performers. They're all down by more than 2.5%. We'll be talking more about the banking sector a little bit later.
Indeed we will. But let's get a check on some of the individual stocks on the move with Charlie Wells. Charlie.
Lizzie, a couple surprises this morning, particularly after that report we got about soft sales last month in European autos. You'd think you'd see a lot of red on the screen, but you're actually seeing a fair amount of green right here looking across that European auto space. So this could potentially be markets digesting that while also taking a look at some of the trade tensions, maybe potentially calming down, maybe less bad than feared yesterday. So that is a surprise on the autos front. Also, we are definitely seeing here a lot of intraday moves here for Edenred. So this is that French corporate payments company. They're up over 5%. They had a pretty strong earnings report coming out. Now, this is the company behind those ticket restaurants, so they are in the green right now. Anyone who spent time working in France will remember those up over 5%. Let's flip and talk about a very different story. This is one we're no doubt going to be hearing a lot about over the course of the trading session. That is Novo Nordisk. They're down nearly 3%. They had those disappointing test results yesterday about their weight loss drug compared to competitor Eli Lilly. So the market not liking what it's seeing. They had a very difficult day yesterday. Now, I want to talk about another medical company, a German dialysis company called Fresenius. Now, they are also not having the best morning. They put out an earnings report that also disappointed to some degree. Now, this could speak to a broader trend. It could speak to this issue of the European medical space coming under pressure, this spill out coming from Novo as investors start to look more across the board, having questions about that medical space here in Europe. Now, better picture across the European telecom space. If you look at Telefonica, you can see they are up over 1%. Now, they had a really difficult November. They had an investor day that disappointed, but they just put out an earnings release that actually showed growth coming from some very competitive markets, growth coming from Brazil, coming from Spain. So investors this morning liking what they're seeing out of Telefonica.
Okay. Thank you very much, Charlie Wells, with those movers this morning. Another mover for you, Standard Chartered. We will focus on this stock when we come back, announcing a $1.5 billion buyback. We will hear from the CEO about the company's fourth quarter earnings, about the mysterious departure of the CFO, and we will also focus in on the wider sector. We'll talk banks. That's coming up shortly. This is Buyback.
Welcome back to the opening trade. We're 17 minutes into today's session, and as you can see, it is red across the screen this morning. The Stoxx 600 down nearly 0.2%. Weakness as well in Germany and France and here in London. And at the bottom of the sectoral basket are the banks. We have banks down about 1.8% as a group. Standard Chartered down 0.5%. And Anna, this comes off the back of their earnings.
Yeah, absolutely. So Standard Chartered announcing a fresh buyback with the earnings, $1.5 billion, as the company reported weaker than estimated fourth quarter earnings, weeks after its share price was hit by the surprise departure of the company's CFO. The lender's CEO, Bill Winters, spoke to Bloomberg earlier.
We've actually produced a great set of earnings in 2025. Q4 was strong in almost every regard. I mean, really all of the key elements of our strategy are firing on all cylinders. And while the share price has appreciated a lot, we think there's a lot further to go. So we're very happy to buy an additional $1.5 billion back. We also significantly increased our dividend in the fourth quarter, so for the full year of 2025. And that's a further sign of confidence in our ability to grow our earnings from here.
For more, we're joined by our finance and investing managing editor for EMEA, Tom Metcalf, who's with us on set this morning. Good morning to you, Tom. So talk us through Standard Chartered's fourth quarter earnings then, and the message we should take away this time.
Well, certainly Bill Winters wants to take away the message of confidence. There's this big buyback, saying dividends, higher than ever. I think the interesting thing is they did nonetheless miss profit in the quarter, which is always sort of pause. That might be why the shares are sort of being dragged down somewhat. But I think, certainly from, the official line is, look, we've got this very clear strategy. We are executing quarter to quarter. Don't listen to too much of the noise. Fundamentally, we're keeping a lid on costs. And basically the bank is in good shape, and hence we can kind of look to return more and more capital to investors.
And very nobly, his pay is staying flat, but they've boosted the bonus pool 10%. I also want to talk about the CFO, because he was a bit more cagey about that, was Bill Winters this morning. He said to the media call that he doesn't know why the old CFO left. What does that say to you, Tom?
I think it shows what an awkward situation it is fundamentally, right? Big surprise departure 2 weeks before results. Obviously for this, fantastic sounding job at Apollo, head of Europe. But it really does speak to the fact normally these things are very choreographed. In this case, it just looks like there was some kind of, rupture where, perhaps dispute personality-wise or something like that. Or, we reported, CFO is very keen to have a bit of clarity on when he might be kind of in the run-in to take over Bill Winters' jobs. And that was the other thing, Bill Winters was saying is, look, I believe in the strategy. I want to make sure I deliver it, see it through. And that really signals he's probably around for, several more years, having already been there. I think he's one of Europe's longest tenured CEOs. So a lot of sort of Shakespearean dynamics behind the scenes there, maybe.
I spent a lot of time with the CFO. There he is on your screens. And some of these pictures come from the episode of that CFO show that we did with him. And the story they were telling then was very much about this sort of double act. And
what's the secret?
Well, maybe George, maybe he did feel he was in the running for the top job, as you say, and that's part of the story. Something else that's befuddling us this morning is why European bank stocks are down a bit. I mean, not a huge amount, but a bit. We can point to things that it might be, AI trade scares, Standard Chartered, some of the issues there. But the banks that are weaker across Europe don't have a huge amount of overlap with Standard Chartered. So just, where will we be looking next for clues?
Yeah, exactly. It's a very mean question, Anna, because I have absolutely no idea. No, it's one of those things where you're looking and going, OK, looks like some kind of pan-European, risk off for whatever reason, perhaps specific to banks. As I say, I always look at AI in these days, is there a reason there? Or, again, it's all context, right? A lot of these banks had great run-ups, as Standard Chartered have. So, some of that kind of profit-taking might also be the case. But hard to know.
Well, we put you on the spot. Tom Metcalf, our EMEA Finance and Investing Managing Editor. Thank you. Well, JPMorgan Chase CEO Jamie Dimon was asked about fierce competition across the financial industry. He said that he's starting to see parallels to the era before the 2008 financial crisis. The CEO has been warning for months about the potential deterioration in credit quality.
Unfortunately, we did see this in 05, and 06, and 07. Almost the same thing. The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. They're just doing dumb things to create NII or say they're, winning in the markets business, something like that.
Bloomberg senior reporter Silas Brown's here for more. Silas, is Jamie Dimon fair there to compare what we're seeing now to the pre-GFC period?
I mean, I think we'll have to wait and see. But like what I think his comments do, and his previous comments that he's made, is pit him against a kind of raft of emerging kind of Wall Street power players in sort of Mark Rowan and Mike Arrighetti and kind of this kind of new group of private credit titans. And I think, look, what is clear and not, as it were, debatable is that there has been a kind of boom in all manner of lending products in the post-crisis period. What I think is harder to say is I think there's still not a huge amount of stress in the system. So a lot of the jitters are kind of presupposing stress. And so, I don't know, we'll see. We'll have to wait to see, basically.
Yeah, because credit spreads in public markets are quite tight still, and people point to that as being a sign of sort of maybe complacency about where those jitters or those cockroaches might be. I mean, Jamie Dimon, on the one hand, they rival these private equity, private capital businesses, private credit businesses, don't they? On the other hand, they service them as clients. So it's a complex relationship, isn't it, Silas? What about the broader credit fears then creeping back into markets this week? What is the broader view of private credit? Yesterday we saw some of those private market equities really caught in the downdraft of the latest AI fears.
Yeah, I think, look, I think the main concern is private markets was kind of built on an idea that they would avoid what they perceive to be cyclical industries. And so that narrows the kind of pool of industries that they can go for. And software, partly because of Dodd-Frank and the perception that software lending was more aggressive than other forms of lending, that moved into the private sphere. And so actually, in terms of concentration, there's a huge amount of software lending occurring in private markets. And so I think, with a sort of transformative technology in AI, I do think it's concerning, and it's hard to underwrite over a long period of time into a kind of sector that's in such change.
Yeah, Citi saying that the AI sell-off could lead to a slowdown in private markets. How much is that a European problem?
Firstly, I think it is leading and has led to a slowdown in private markets. I mean, there are a number of deals that have been stalled or paused as a result of these kind of concerns. And if you put yourself into the mind of a private equity investor or a private credit investor, right, you're supposed to be kind of gauging the long-term health and progress of a company. How can you do that when it's very hard to know how the company is going to respond over the mid to long term to things like AI? So I don't know. I mean, in the US, there's much more data and it's much more visible to see kind of what the holdings are in private equity and private credit more notably. I think it is more of a US story, but it's significant in Europe as well. I mean, there's a huge amount of budding software as a service companies here that are in the private markets.
Yeah. And Silas, back to where we started this conversation and the comments from Jamie Dimon. I mean, on the one hand, he is saying, well, some of the trouble could come from AI. That's what people are worrying about. But he is saying that AI is not going to have a major impact on credit losses. Do you think he's just talking about the JPMorgan book there and what he knows of it? Or is he giving us a broader assessment of how AI and credit markets interact?
Yeah, I mean, look, I think if you speak to the kind of proponents of software and the kind of more sort of bullish case for software, you'd say, well, look, these software firms are in a very advantageous position because they have the clients that the AI natives don't have. And so if they can catch up with the technology ahead of AI can catch up with the clients, they're in a kind of this brilliant position. I don't know. I think that is we'll have to wait to see how that bears out. I mean, I think a lot of credit markets is to do with confidence, and at the moment there seems to be quite a lot of public signs of jitters.
Yeah.
However, much like credit markets, they're always sort of like a Rorschach test. You can kind of make of it what you will, because they're also very highly accommodating. There's been these large-scale M&A financings in the public markets, and so they're kind of open to business as well.
Silas, thank you very much. Bloomberg senior reporter Silas Brown on all things private credit. Coming up on the programme, we'll stick with the tech themes of late. The UK entrepreneurs, a group of them, are launching a campaign to improve the environment for Britain's fastest growing companies. Brent Hoberman, co-chair of Enterprise Britain and executive chair of Founders Forum, joins us next. We'll get his take on the latest selling as well. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session, and as you can see, it is red across the screen when it comes to the European equities picture this morning. Only slightly to the downside when it comes to the Stock 600. We thought the AI scare trade was over, and the futures picture had been positive earlier, but now it is not so much positive anymore. Banks at the bottom of the sectoral basket. Anna, what are you looking at under the hood?
Yeah, let's have a look at where we are in terms of the dynamics within the markets. And Stock 600 kind of split really between those that are moving higher and lower. A little bit more emphasis on the upside, but not a huge amount. 330 place, 255 or so. This is the number that catches my attention, though, today. Volume is higher. We have the Chinese markets back. We have the US, of course, really disrupted by some of that snow yesterday. And so could we be seeing today a little bit more cleaner expression of investors' appetites? And we do see volumes up 46%, of course, versus the 20-day average. Let's have a look at some of the stocks that have been doing well and doing a little less well over the session as it is so far, just half an hour in. ASML is higher, substantially so, up by 1.6%. Now, is that to do with some of the reporting we've seen from other media around the yield they can get on those chips, or is this around the Asia coming back, Asia hardware trade? Rheinmetall is also moving higher. There's talk of drone orders there. Shell is up by 0.7% as well. Let's switch the board and show you the laggards, some of the stocks that are not doing so well this morning. Novo was certainly in the crosshairs yesterday, down more than 10% in yesterday's session. Fears around its weight loss drugs, and some investors now calling on the business to broaden its portfolio. Fresenius Medical Care, that company had numbers out earlier on today. The stock is down by 7.3%. And Santander in focus, down by 2.4%. One of those banks, Lizzie, that you mentioned that is bringing up the rear today. The banking sector is underperforming. Is it to do with AI? That's certainly one of the theories being posited, but it's a broad-based move to the downside, just a little lower for the European banking sector.
What else do you need to know this morning? Let's get you an update on stories from around the world. US President Donald Trump will speak to Congress later today in the first State of the Union address of his second term. The speech is expected to showcase priorities for the Republican administration, centred largely on the economy, immigration and national security. Elsewhere, the yen extending declines this morning after local media reported that Japanese Prime Minister Sanai Takaichi voiced apprehension over more rate hikes in a meeting with Bank of Japan Governor Kazuo Ueda last week. The Mainichi newspaper reporting that Takaichi took a, quote, tougher stance than her previous meeting in November. And Bloomberg has learned that Anthropic is offering some current and former employees the ability to sell shares in the company at a valuation of about $350 billion. That would allow them to cash in at the same level as a recent $30 billion funding round. We're told the company has lined up $5 billion to $6 billion for the share sale, but the final amount will depend on how many eligible employees opt to sell. Anna.
Let's stick with technology themes then, Lizzie. US futures are pointing higher as the so-called AI scare trade shows signs of cooling, perhaps, for now. A series of warnings about the disruptive power of AI dominated yesterday's session on Wall Street. Black Swan author Nassim Taleb was out predicting bankruptcies in the software sector, and Citrini Research was out with a bearish report that cited an impact on a host of sectors. The author of that report told Bloomberg TV even he was surprised by the market reaction.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically, the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months.
Bloomberg senior strategist Neil Campling joins us now with thoughts on what we've seen at the coalface of this AI scare trade. The Citrini report then, Neil, certainly front and centre. I mean, even the author seems surprised. We've seen that with quite a few of the beneficiaries, if that's the right way to describe it. Some of the CEOs of those businesses that have benefited in recent sessions have also been surprised at the impact that they've had on markets. What do you make of the Citrini report and its fallout?
OK, so I think, firstly, if we look at this Citrini piece, it's interesting because it's a thought-provoking thematic piece looking at what may be the future, but it's in 2 years' time, 2 to 3 years' time. Now, it maps a scenario of AI-driven white-collar displacement, triggering an unbreakable feedback loop. You have software collapsing, mortgages structurally impaired, unemployment going to double digits. There's some really interesting aspects to this. I think the reaction is because the market and investors are very nervous about trying to understand the impacts of AI. And certainly, I think AI has, as you just had with the interview, I would agree with that the AI developments in the last 6 months are significant. There have been huge advances. However, what we're seeing, I think, is that the biggest debate is around timelines. Probably, the direction of AI improvements is not in doubt. However, the idea of a 2-year timeline, I think, is a big issue because it probably you've got to consider that the numbers of people actually using AI, using even chatbots, is very, very low. The cost of intelligence is collapsing towards zero. That actually helps in terms of improvements in access. But you kind of need to, I think, also consider things like, political situations will act as a brake to any tech advancement, and that's an issue. Reindustrialization of industries, of different parts of the economy, move at human speeds, much slower than the tech actually enables them to do. And still requires a lot of construction to take place. Some of the sort of terms within the report suggested that within 2 years, the likes of the payment gateways, Visa and MasterCard, will become almost irrelevant because everything could be done through stablecoin. And I think that's a little bit far-fetched, but the types of reactions we saw yesterday were certainly indicative of the nervousness that investors face because of the uncertainties and the unknowns as to how the impacts play out. And actually, we're going to have even more, I think, focus later today because Anthropic are hosting a live event, 2:30 London time, where they're going to showcase some of these new tools. So, you've seen tech volatility recently, and there's every chance that that's going to continue this week.
Okay, Neil, thanks so much. That's Bloomberg senior strategist Neil Campling. Well, sticking with the tech theme, top entrepreneurs in the UK are launching a campaign to improve the environment for Britain's fastest growing companies. We're joined now by Brent Hoberman, co-chair of a new group, Enterprise Britain. Brent's also co-founder and executive chairman of First Minute Capital and Founders Forum Group. So, Brent, it's great to have you with us. You've launched Enterprise Britain to help grow British companies into global champions. You talk about shaping the new world order rather than being shaped by it. Realistically, can the UK compete with the likes of the US and China when it comes to AI? Where are we, would you say, realistically in that race?
Yeah, we've launched this movement, Enterprise Britain, because we've had countless conversations with some of the best entrepreneurs and leaders in the UK, and they've chosen to stay in the UK. Some entrepreneurs have left, but those who've chosen to stay are staying because there are so many advantages of being in the UK, but we could enter a bit of a doom loop, and as you say, in this AI, can we be an AI leader as well, etc. So we want more ambitious policies, more support for entrepreneurs, more people to benefit from the growth of those entrepreneurs, a nation of shareholders. And so as regards to whether we can lead, I think we can certainly lead in AI adoption, but it's not happening yet. But we can. I think Brits often are early adopters, so let's push on that thread. And then obviously there are some world-class companies in AI here. We're going to hear more about Wave, which is rumored to be closing around at over $8 billion, which is a British company, one of the biggest AI companies in Europe, and it's come as a Cambridge spin-out. It's a flagship out of there. We were lucky to be seed investors.
But some of the CEOs on your board have been very cagey about whether or not they'll list in the UK when the time comes. Surely that matters?
It matters a bit about where you list. I think you could over-egg it. Of course, we'd love them to list here. But I think that what we're trying to go is much broader than where a company's listing. We're trying to say, what's the friction why are there not more amazing entrepreneurs succeeding in the UK? There is a lot of drag for entrepreneurs here. I've always said, and when I did Last Minute Comment a million years ago, it was like, you have to be 10x, 100x better to be a pan-European entrepreneur than to be an American entrepreneur who can succeed across there. So there's so much friction. We need governments to be asking the right exam questions to support these entrepreneurs.
Brent, good morning. You're calling then for more shareholder culture. So this
Yes.
isn't just a sort of tech-focused initiative.
No.
This is, how do we fund these tech businesses?
Yes.
How do we scale up these tech businesses, which has always been the issue? You want more shareholder culture, but I've lost track of the number of reform agendas we've had on this front. The Edinburgh reforms, Mansion House reforms. I mean, do you have a sense that this push of yours can really make a difference?
Well, so obviously we've got, in Britain, retail shares are one of the lowest in the world at 8% rather than the US 33%. So that's one example of where consumers aren't benefiting from.
Reasons for that, around pensions and
things. And if you talk to the pension guys, they're saying, look, there are all these sort of hard things. But again, it goes to the heart of the report. We have to be bolder, we have to act faster, and we have to take more risks. We've become a culture post the 2018 crash where everything is risk averse, and nobody is, and nobody. It's very hard for people in government and business leaders to take risk. So we're saying we've got to be bolder because it's the time to act now, which is our ambition, capital, and talent.
Okay, let's talk risk then, because risk and AI attached to it has been all over markets for the last few weeks, since the start of this year, certainly. You talk about leaning into AI and being a leader in AI. We were just talking about a report by Citrini, which has really dominated the conversation just for 24 hours. But they cite a sort of, as we were hearing from Neil, a doom loop between AI creating the collapse of software companies, collapse of the consumer, collapse of housing markets, unemployment in double digits. Does this sound like a risk you want to lean into?
I don't even think they really believe it. What they painted is a science fiction. They painted a sort of science fiction. This is what could happen in 2 years' time. And the market sort of maybe got carried away, as the market tends to do. But do we want to lead into AI? Absolutely. What is missing from that is AI can kill cancer. It can make people much more productive. We need to massively improve productivity in this country. And also, AI can help companies improve their margins dramatically. Something that was missed from the Citrini report, I think, is that AI leads to productivity, can improve margins. Now, yes, absolutely. Will it cause issues in terms of structural unemployment? Yes. So that we're also calling, we agree, scenario planning is interesting, is essential, and we need to think about how you do that and how we educate and reskill people. And it's great to see this government leaning into reskilling 10 million people and companies like Google backing that.
Yeah, it's interesting you say the unemployment then, is it structurally, it's inevitable, is it? Because there could be, if this takes longer to play out, there could be an argument that maybe unemployment doesn't spike and people are repositioned into other roles.
When you listen to people like Demis and Dario, some of the leaders in this thing, they do, I think, say it's going to happen very fast and it's going to be hard to... it's everything everywhere all at once with AI. That's why it is quite dramatic. So there will be some need for some structural issues of how we deal with that. But of course, there will be new opportunities for people. But AI we can't resist it. It's a torrent that's coming towards us, and you don't want to be the last country to adopt it.
So just coming back to the report on Enterprise Britain and how you get these entrepreneurs to be in the UK. I was in Milan recently and they've got the flat tax regime. All the rich people seem to be going there, and we've dismantled the non-dom regime. Do we not need a carrot to dangle a la Italy?
Yes, thank you, Lizzie. I am so excited about making this, getting a message to global entrepreneurs, the best talent worldwide, to say, come to the UK. Here are 10 reasons why. Here's what we're going to do for you. Things like an investor visa where people pay a lot to be in this country.
It's one thing.
It's one thing, and I think a series of tax incentives are absolutely right. I think if people have succeeded in other countries, we want them to succeed here, we want them to move here, and we want them to have a package of things of which tax has to be one.
Does reform sound like they're on the right track when they're talking about getting business going here in the UK?
We're not here to endorse any political party. I think, the good news is we want this wave of entrepreneurs to encourage and make it possible for governments of all colours to support entrepreneurs. We want to make it more popular. And one of the things that comes from this report is the younger generation can't name any entrepreneurs. They want to be entrepreneurs. They can't name them, and they're too scared of the risks of being an entrepreneur. So there are lots of things that we need to boost the ambition, highlight the world's best entrepreneurs. Let's have a minister for entrepreneurship that focuses on this. Let's have a minister for talent that focuses on bringing the talent into the UK. Let's make these even bigger priorities for governments of all stripes in this country.
OK, Brent, great to see you. Thank you. That was Brent Hoberman, co-chair of Enterprise Britain and executive chair of First Minute Capital and Founders Forum Group. Well, coming up on the programme, as we await President Trump's State of the Union address, we'll discuss the US economy and tariffs chaos with Sandra Horsfield from Investec. That's next. This is Bloomberg.
Welcome back. This is the opening trade. 48 minutes into a session that we expected to be fairly flat at the start of trade. It hasn't turned out to be that way. We are a little bit weaker across the European equity space this morning, continuing to worry about AI perhaps, down 0.4% on the DAX, not far behind that on the FTSE 100, in fact. And US futures now are flat. They had been suggesting something a little more positive, Lizzie, but now we are flat on E-minis and Nasdaq futures after the day that was yesterday.
So that's what's happening in the markets. Meanwhile, President Trump's new 10% global tariffs kicked in a couple of hours ago, and an administration official says the White House is working on a formal order to increase the levy to 15%. Now, this is after the Supreme Court, of course, struck down Trump's original sweeping duties. And amid the chaos, we'll be keenly watching out for President Trump's State of the Union address tonight in the US and tomorrow morning for Europe. Joining us to discuss is Sandra Horsfield, economist at Investec. Sandra, good morning. Thanks for being here. As we review all of this that came out of the tariff drama over the weekend, you've got many saying it's a lower effective tariff rate, but then prolonged trade uncertainty. Net, is it bad for the economy?
For the time being, what we have is a stopgap. It is not the final end state for tariffs. And I think the uncertainty this generates clearly makes life more difficult for companies, and it makes life more difficult for markets as well.
Well, yeah, if companies start hiking prices amid this uncertainty, and given that the FOMC minutes were hawkish, is a Fed hike back in play?
Well, there's certainly some of the more hawkish Fed members have talked about that possibility. I think the big picture for the time being, as things stand, is that we are actually seeing a reduction in the applicable average tariff rate. As things stand, though, is a crucial phrase at this point, because, of course, we know that where we are now is not where the administration wants to end up in the final place. So we will have to wait and see how that develops.
Yes, and it seems that some President Trump's popularity ratings linking with regards to tariffs, he's under pressure on that front, and not all Americans, and certainly more than 60% of Americans, don't like what he's doing on tariffs, it would seem. So tariffs probably get a mention in the State of the Union address, we'd think. But in terms of affordability, in terms of tackling the cost of living, what should we be watching out for in the State of the Union, given the areas of the market he's talked about in the past where he is focused on affordability?
I think we've certainly seen elements of affordability make it to the top of his agenda in the past. So we've had mentions of credit card fees being capped. We've had mentions of the housing market being looked at. These are obviously all crucial parts, and affordability really is the key issues for voters at this point. What more can be done? Well, certainly, I think this administration is much more happy to step into areas that other administrations would have stepped out of. So I wouldn't be surprised if we were to get more along these lines being addressed at this point.
Yeah, and sharing the burden, if there is one, of the higher cost of energy as a result of AI and data centres might be something of a theme. Our reporting suggesting that maybe President Trump will be calling on those who operate data centres to pay more of the cost of energy. How concerned are you about energy prices in the United States?
I think the important thing to remember is the US is a net energy producer at this point. And that is something that has shaped a lot of what is happening at this point. Of course, the demand by certain areas, such as AI, is very great for energy. It's very localized as well. So it's not necessarily that easy to spread that and shelter households from the inflationary impacts of that. At the same time, we do have this big drive up to boost energy production. And of course, that is meant to counterweight some of that as the overall picture balances out.
Sandra, let me ask you about the UK, because we saw unemployment overshoot, inflation dropping. Is March now live for the BOE?
Well, I think the Bank of England has taken a somewhat different approach to looking at the labour market than beforehand. It is now much less concerned about wage persistence, which is something it had talked about for a long time. At this point, though, the question is, will the labour market really develop as they think? Will we get more of a loosening in the labour market, or indeed will we get this easing in inflation pushing through? March is certainly a live possibility, but then on Friday we had data that suggested that perhaps the economy actually fared better than it thought at the start of this year. So it is certainly not a done deal as yet, as far as we are concerned.
OK, well, we'll be hearing from BOE officials, of course, later on. But I also want to ask you about the politics, because you've got this Gorton and Denton by-election coming up later on in the week. Betting markets say that it's going to be the Greens that win. Do we see less gilt and sterling volatility if that's the case, rather than a reform victory? Or is it that if the Greens win, there's a worry that Labour is dragged further to the left and it becomes looser fiscally?
I think political worries are certainly a factor to take into account. Exactly who would win instead of Labour, if that was what was to happen, perhaps doesn't matter so much. The mere fact that there is a lot of pressure on the government to deliver something different, to convince voters that it can yet deliver the change that they had voted for, is an issue. And the question is, will that be under Keir Starmer or somebody in an equally centrist camp, or will the Labour Party decide to shift in some other directions? The by-election is certainly one big test. And the second bigger question perhaps still are the May local elections. So we could see that there could be more volatility in the gilt market, perhaps also in sterling in the interim.
Anyone more market-friendly than Keir Starmer of the potential runners and riders to replace him?
Probably it's a matter of can we maintain his market friendliness in a relative sense, rather than can we find somebody who's more market friendly at this point.
OK, Sandra, thank you so much. That's Sandra Horsfield, economist over at Investec. Well, let's have a look at what's on the agenda for today. We have Ursula von der Leyen in Kyiv as the war in Ukraine enters a fifth year. Meanwhile, the EU General Affairs Council is meeting in Brussels today. We've got plenty of Fed speak as well, including from Chicago's Austin Goolsbee, Governors Christopher Waller and Lisa Cook. And then at 4 p.m. London time, we have Apple's AGM before the real finale of the day, which is, of course, President Trump delivering his State of the Union address in the evening stateside, in the morning for us here in Europe.
Yes, absolutely. State of the Union will certainly be a big preoccupation for us tomorrow. So, yes, into our Wednesday, that will be, won't it, Lizzie? Taking on board everything he has to say around affordability. Where will his laser focus go? How market moving will it be? And thinking of markets, I'm drawn to the fact that US futures are actually pretty flat now. When we started this programme a couple of hours ago, we had US futures actually pointing in a much more positive or slightly more positive direction. They are really quite flat right now.
Yeah, flat to the upside. And the European session, not what we thought it would be either. The stock 600 down 0.2%. Are banks still at the bottom of the basket? I do have to wonder. Let me check quick.
They are.
Are they? Still going?
Yeah, banks.
Right. We don't really know why. Perhaps the AI, perhaps the StanChart earnings.
Yeah, banks down by 1.8%. That sector under some pressure, it would seem. But on the other side of things, autos and parts going higher. We'll keep an eye. Neil Campling was telling us about Anthropic doing a demonstration of its Claude tools later on, its Claude chatbot. And so we'll certainly keep an eye on that in case that adds another spanner to the works.
We've got an interview with Chicago Fed President Austin Goolsbee to bring you at 2:30 p.m. London time, so don't miss that right here on Bloomberg TV. But that does it for the opening trade. The Pulse is up next. This is Bloomberg.